The orders came largely from infrastructure sector, and this has been the pattern for the company for many years now. 57% of the orders that we procured during the year came from infrastructure vertical. We had hydrocarbon contributing 10% of the orders that we have won during the year. And the services business, and since it is a consolidated results that we are announcing, the services business revenues are treated as orders, and they account for 17% of the total order inflow for the year. The order book, we spoke about the order book at 2.6 trillion. If I look at the E&C revenues that the company is likely to have at the current rate, the order book reflects 3 times the E&C book to bill. What this indicates is a certain predictability to the revenue profile of the company for the next 3 years. And there are enough orders in the tank for us to work on to be able to sustain the revenue and profit growth plans of the next 3 years. This is not to say that we do not need any further new orders in the 3-year period that we are talking about, but all that we are saying is the baseline is adequately covered, and what we need is the top-up churn that the environment will provide us the opportunity, and L&T will have the competency and the competitive advantage to take advantage of that situation. We do think that close to 2 trillion rupees is from infrastructure orders, so the revenue profile of the company will reflect the huge backlog of infrastructure orders that we have. And with hydrocarbon joining the party, so to speak, we have almost 266 billion rupees from hydrocarbon, which will also play out over the next couple of years. Just a point, while the infrastructure orders are long gestation orders generally, hydrocarbon is relatively short gestation. To that extent, their conversion into revenue could be faster. The performance of the company, both for the quarter and for the full year, in terms of revenue, the performance have been moderated, the revenue lines have been moderated for the GST and the excise duty adjustments that I spoke about. So for the quarter, the revenues are at 407 billion rupees, which is 11% growth. And for the full year, it is at 1.1 trillion rupees, which is 9.5% growth. The international revenues, the share of revenues from international contracts is 29% for the Q4 and 33% for year as a whole. We do believe, given the backlog of international orders that we have, around 30 to 32% would continue to be the share of international revenues in the order book going forward. The manufacturing and construction expenses reflect the improvement that we have made in terms of operational efficiency programs that we are running across the company. So even though the absolute numbers have shown an increase from 727 billion rupees to 773 billion rupees, a 6% growth, the fact that the rate of growth is lower than the rate of growth of revenues indicate that these have been a major contributory to the growing EBITDA of the company. The finance charges are actually the finance cost of the financial services business, which are treated on par with the manufacturing and construction cost, because for finance business, money is the raw material. They have grown by 12% from 54 billion rupees to 60 billion rupees for the full year FY18. The staff costs have recorded a 10% increase from 139 billion rupees to 153 billion rupees for the year as a whole, and these are largely on account of staff augmentation that we have done for the services business and the staff rationalization that we have done in some of the core projects and engineering businesses. The sales and administration cost records a 10% increase for the year as a whole from 70 billion rupees to 77 billion rupees, and these reflect the provisioning that we have made both in financial services business and all the other businesses in terms of non-recoverability of customers' dues in terms of anticipation. The total operating expenditure has moved up by 7% from 989 billion rupees for the year ended March 17 to 1 trillion rupees for the March 18 period, recording a growth of 7%. Consequently, the EBITDA of the company has been 54 billion rupees for the quarter ended March 18 and for the year ended March 18 at 136 billion rupees, which is a 22% increase. The EBITDA margin are gone up by 120 basis points from 10% to 11.2%. The finance cost has shown an increase of 15% for the period ended March 18, the year ended March 18. And these reflect largely the larger funds that were in use during the period of the 12 months, and a 40 basis points increase that has been witnessed in the financing cost. The depreciation and amortization shows a reduction. That is largely because of the amortization that we did to some of our assets in the previous year, which no more exists in the current year. Consequently, the depreciation and amortization line are more normative than they were reflected in the past year. Other income has grown by 5%, largely representing our treasury income. We had exceptional items in terms of sale of some of our small businesses, which has $1 billion in terms of contribution to profits, and they were quite similar in the previous year as well, because as a part of our portfolio restructuring, we are constantly looking to exit some of the subscale businesses, which though profitable, does not provide us the ammunition to scale the revenue and the growth targets that we have for future. The profit after tax, hence, at 74 billion rupees records a 22% growth over the 60 billion that we recorded in the past year. Connecting the financial results with the segment performance, you are very familiar with the segments that we have been reporting, and there are no changes to the segment reports that we have produced so far. And hence, looking at the individual segments, we have infrastructure segment as the lead segment, which has a quarterly revenue of 229 billion rupees, which is 14.6% growth over the 200 billion rupees of the previous year, quarter 4. And for the year as a whole at 590 billion, it is up by 11.8%. The overall revenue growth of the company is largely aided by the growth of this segment, both in the quarter 4 as well as for the full year. The share of international revenues for this segment has been for the year as a whole 173 billion rupees out of the 590 billion rupees that we have reported income. The EBITDA margins have marginally declined from 10.2 to 10 for the infrastructure segment for the year as a whole, and these are largely reflective of the mix of jobs and the stage of completion that they are in, and do not indicate anything in terms of structural direction. When it comes to power, the segment, as you know, is facing a lot of headwinds in terms of opportunities for thermal power. And we, as you know, we do the EPC business for thermal power, and the intense competition for the limited opportunities that are existing both by the domestic players and the international players. Consequently, we have not been able to win orders of the magnitude that we would prefer to keep this segment in pink of health. There has been some compensation by the segment winning some orders overseas. We won an order in Bangladesh, and this is continuation of a couple of orders that we have won in the prior year. So the segment revenue overall shows a decline of 10.6% for the year as a whole, from 69 billion rupees to 62 billion rupees, reflecting the declining order book. It's very important that this segment begins to win some orders for the growth trajectory to return back to the revenue lines. Otherwise, it will tend to reflect the decline that is evidenced by the order book. The EBITDA margins stays low at 3.4%, marginally lower than the 3.5% of the previous year. And it is important to know that at EBITDA level, the performance of the subsidiary companies that we have in the power segment, namely the JV for manufacturing boiler and the JV for manufacturing turbine, those profits are not included in the EBITDA level at the segment. They're included at the PAT level of the segment, and it will be interesting for you to note that about 150-160 crores of profit are made by those JVs for the year as a whole, which will go to improve the overall returns of this segment. Moving on to hydrocarbon segment, the turnaround has been complete. A couple of years ago, this segment was under a lot of stress in terms of orders where costs and time overruns were hurting the financial outcome. For the quarter ended March 18, the revenues recorded were 35 billion rupees, which is a 37.9% growth over the quarter 4 of the previous year. And for the year as a whole at 1.17 trillion rupees, it reflects a 22% growth. The share of international revenue is significant for this segment, largely because of the order backlog, which reflected the international orders that the segment won in the prior years. The EBITDA margins consequently has improved from 6.8 to 7.7%, reflecting the increased scale of operations as well as timely execution. The projects that we are currently executing are all on time and on schedule.
Well, a great set of numbers and some important fine print coming in with respect to the order flows and the outlook going forward.